Let's start. Kathy, let me start with you. I kind of smiled because you said that the Fed chair was more hawkish, but his overall tone was dovish. So that's the perfect. That's what I guess we figured that was going to be what he tried to thread as far as a needle goes. But you thought he was successful.
Yeah, I mean, he has a lot to juggle. I do think he overall wants to give a dovish message. They're not in any hurry to raise interest rates. They're just starting to embark upon tapering of QE, which we know they need to finish. At least they told us they'll finish that first. That's their playbook unless something unexpected happens. But at the same time, the dot plot estimates, the interest rate expectations all moved higher, and they're split now whether they should raise interest rates next year, so have rate liftoff. So he had to balance all of that. Kind of what struck me is, yes, it was a dovish message, but it was a little less so. And the question is that really his feelings, or does he have to represent, the entire committee, which is moving a bit more hawkish?
I mean, when you add everything that the Fed is dealing with you've got these, and it's all related to COVID, I guess, because the bottlenecks are related to COVID. So you've got this possible inflationary period that we're heading into that may or may not be the Fed's fault, may or may not be transitory, but you've also got fears of a possible slowdown if we don't get the variant under control. So it's very difficult he's got to do, they kind of have to do both things, but we do know that asset inflation is everywhere too. So I don't envy what they're trying to do. Can they do it successfully, or do you think there's already a problem for where we are?
Well, there are a lot of risks. And interestingly, they release their own perspective on the uncertainty surrounding their forecasts. And it's the highest in about 8 to 10 years, both on GDP and inflation. And the risks are much higher now on inflation when they're evaluating their own forecasts, and they see increasing downside risks to GDP. So that's not a great position to be in, frankly, as a central banker. We'll see how they can navigate it, but there's lots of challenges, headwinds both ways. And I agree with you, Joe. I think the key are the supply chain issues. And if those can get worked out, it means we can have stronger growth and lower inflation. That's really where the Fed wants things to head.
And Gunjan, you once again point to that investors should never underestimate the inclination to buy dips, and we saw it again, and it happened again. And there was a question this time. It's been working. El Arian says, don't fight that. It's working. It's been working for a long time, and it's not going to end anytime soon. That's related to the Fed, I think, because you totally. Always know you can always buy a dip because you got the Fed there. So it's related. But how will we know when that started, when we're starting to see that not work, or signs that it's not going to work next time?
I mean, I totally agree. It is related to the Fed, right? And they've done such a good job of telegraphing this tapering and their potential paths for rate hikes. And that has buttressed this buy the dip trade. And, what was striking to me was Monday, as we saw the biggest sell-off in months since May, we saw JP Morgan come in and say, we think this is technically driven and it's time to buy the dip. And it certainly seems like investors continue to do that throughout the week. And you're seeing that in the futures market today. And I think especially with the higher individual investor interest in markets that we've seen over the past year, that's one key thing that people are watching is how long will this trade persist and when will it stop working? And, that's what I'm trying to figure out as well.
Well, shouldn't we just keep it simple and say, since it is in large part due to knowing the Fed is there, if the Fed starts the second derivative, just starts lessening the amount of accommodation, and you see that they've passed the Rubicon and it's starting to head the other way, shouldn't that be when the dip buying, shouldn't that be the sign that it might not be as strong an inclination? I mean, it's coming. Yeah.
It is coming, but again, they've telegraphed this so well, right? And we saw them lay out this path yesterday, and the market was still not deterred, right? The market staged an incredible rebound yesterday.
Yeah, it did. But that's what's hard to figure, because we know the market discounts things, so the market may already be discounting the beginning of tapering and maybe even moving in the first rate hikes to like late next year or something. But Markets. Why is the transportation average down so much, Gunjan? Can you ask someone that, or even though everything else is? What do you think?
Yeah, I mean that's a good question. I think we have seen this back and forth all year with like the value trade and the growth trade, and it looks like that's going to continue to play out. I think one key thing to keep in mind is, as you pointed out with these risks, you know, the mood has shifted in September, right? We've had a number of banks come in and say, we're cautious on stocks. Morgan Stanley said there's a growing likelihood of a 20% drop in the S&P 500. So people do seem to be on edge in certain corners of the market.